Considering the current situation in this video, we'll delve deep into Tesla's latest developments, from their game-changing residual solar and battery storage solutions to their ambitious plans for humanoid robots. So grab your popcorn and join us as we explore this fascinating company. Is it possible for Tesla stock to reach all-time highs again? If so, how will they do that? And when would be the right time to buy? Before you do anything else, please make sure to like this video. Then settle back and join us as we explore the fascinating world of Tesla and the future of sustainable transportation. Also subscribe to Tesla Insights. The business unexpectedly declared that it would not allow its automotive division's gross margin to drop below 20%, but when they failed to meet this goal in the first quarter, reality set in itself. Although Tesla had promised investors that they would keep this margin throughout the year, the new price cuts are projected to cause the margin to shrink even more, which has caused investors to become quite concerned about the situation's scope. Some think that the impact of the pricing would be mitigated by decreasing commodity costs. Cuts, but Tesla's results showed otherwise. They not only missed market expectations, but also fell short of their projection, which caused Tesla stock to decline and made investors hesitant to make snap judgments. Taking into account the advice of top stock expert Dave Ives, who provided insightful information that may influence a person's decision-making process, is essential as we shift our focus to Tesla. This seems like a situation that requires more than just a cappuccino to handle properly. Tesla has been under pressure from 6 price reductions, and the company is battling to maintain margins while increasing unit sales. Although the stock has shown signs of recovery earlier this year, it now needs to show sustainable growth in China. Although I think the stock is oversold, Tesla still needs to prove itself in the second half of the year. The company's profit margin is gradually declining and is predicted to stay on this trajectory in the upcoming months despite the optimism of many testables. Tesla will need to navigate through the ongoing price war and achieve a gross margin in the 20 range, excluding credits. Although there are a few potential bright spots to look forward to, the truth is that Tesla may not be as profitable this year as investors had hoped. If all goes according to plan, Tesla stock may once again skyrocket, possibly reaching the 300 mark. The question is, however, how will the car come probably to this? And what conditions must be met for it to occur? Let's investigate this further. Some Wall Street analysts are worried that recent price cuts may reduce Tesla's margin advantage. Despite this, investors should keep an eye on the wider picture. Although the company did raise prices in the US earlier this month, it did so after a string of price reductions worldwide at the beginning of the year. By maximizing market share and attaining economies of scale, Tesla hopes to become a mass-market automaker and pass on operating cost benefits to consumers. Keeping hope of the automaker could be the best course of action, since Tesla has the capacity to unleash considerable cost savings in the future. This strategy has the potential to reward investors considerably more than a limited volume, high-margin model. The unanswered question is whether Tesla's stock might hit all-time highs once more given the company's strategic direction, which focuses on cost savings and aspirations for as the future develops. We'll see if Tesla can overcome its obstacles and propel its stock to new heights. If you've observed, there has been a considerable decline in Tesla stock. Market expansion is not completely out of the question. However, astute investors have seen the trend and see a chance to investigate the company's other groundbreaking technological advancements. Beyond electric cars, what makes Tesla stock even more alluring is the fact that it is currently trading for a far lower price than it did a few years ago. As of right now, Tesla stock sports an earnings-price ratio of about 45 when compared to the larger stock market's 19.2 P/E ratio. This represents a substantial decline from Tesla's peak PE ratio of more than 2,000. And although some experts and investors are still pessimistic, there is still a lot of hope for the company's future. Recently, the stock moved in response to a statement made by GAM Investments investor director Mark Horton. Horton boldly predicted that the price of Tesla shares will never exceed 300 again, attributing this to the company's reduction in the price of its electric vehicles and its anticipation of lower demand, while concurrently increasing production. The stock's trading volume fell to 46 billion shares, much less than the typical daily volume of 171 million shares, as a result of Horton's pessimistic outlook for Tesla. The stock of Tesla may continue to fall during the coming year due to a number of variables that could affect the company's performance, including fears about inflation. The economy as a whole has been severely impacted by rising interest rates and the threat of a recession, But despite these difficulties, the automaker is benefiting from a number of favorable factors. One of Tesla's unique selling points is that as of 2021, its profit margins typically outpace those of its industry rivals. The business's remarkable $81.5 billion in total revenue translated into $13.7 billion in operating income and a 16.8% margin. Compared to major U.S. competitors like Ford and General Motors, whose margins usually hover in the single digits, this is noticeably greater. A few important elements are responsible for Tesla's extraordinary profitability. First, due to the company's well-known brand, substantial advertising and promotional costs are not necessary. Secondly, Tesla's management has effectively implemented manufacturing efficiencies and vertical integration, enabling in-house battery production, manufacturing, and sales directly to consumers. These calculated actions have increased the company's profit margins and made it a significant participant in the automotive sector. Not only that, but Tesla is also setting the standard for artificial intelligence-powered self-driving software. By 2024, Tesla will be positioned to enter the autonomous ride-hailing market thanks to its cutting-edge technology. Early projections from ARK Invest indicate that autonomous vehicles may bring in a new era of ride-hailing, with a potential market worth of $14 trillion by 2027. Also serve to further solidify Tesla's standing as a creative force to be reckoned with. Tesla is still making progress in the residential market by offering battery storage and solar power options for houses. The first quarter saw a surge for these items due to an outstanding 360% increase in deployed battery storage capacity over the previous year. Gradually, Tesla's manufacturing capacity has matched demand, enabling them to satisfy the expanding demands of the market. Additionally, as more electric vehicle manufacturers reach scale, Tesla plans to introduce Optimus in 2027, a humanoid robot with applications and low-skilled jobs specifically in manufacturing. This presents a significant opportunity and makes Tesla stock an appealing long-term investment. ARK Invest management estimates that a decrease in operational costs will result in higher sales. It is anticipated that the production of electric vehicles worldwide would increase dramatically from 7.8 million units in 2022 to 60 million units in 2027, a compound annual growth rate of 50%. Over time, Tesla's production has substantially increased the charging time of electric vehicles, and this growth rate coincidentally matches with those forecasts. Explains that it only takes 15 minutes to charge an electric car for a 200-mile drive today, compared to 40 minutes 4 years ago. Tesla plans to cut this time even further, to just 4 minutes in the next 5 years. These developments help to promote the widespread use of electric vehicles, even though only 10% of new car sales in 2022 were made of electric vehicles. According to Goldman Sachs, by 2024, the percentage might soar to 61%. This is the first time the firm has reported on emissions related to its supplier chain. While conventional cars continue to burn, their lifetime emissions are significantly higher than those of electric cars. According to studies made by Tesla, during the course of their typical 17-year lifespan, electric automobiles produce 55 tons less CO2 emissions than gasoline-powered vehicles. As it stated in its Investor Day presentation, Tesla intends to cut prices for its next-generation vehicles by 50%. This could support additional price cuts while preserving the industry's highest level of profitability. Although Tesla's stock has a ways to go before hitting its previous peak of $300 per share in December, it has been regaining ground in 2023 and may continue to rise throughout the year. What do you think about Tesla stock hitting $300? Share your assessment of Tesla with us and click Show You There to be notified when we release the next video.